In 2026, the cost to prove you can trade has plummeted. You can now take a prop firm challenge for a mere $50. But that rock-bottom price tag presents a serious problem. Are you actually buying a budget-friendly path to a funded account, or are you just stepping into a subscription trap designed to farm your failure? To figure that out, we have to look past the upfront price. The actual cost of securing prop firm capital has almost nothing to do with the number you see at checkout. This chart maps out the total cost of funding, combining your initial fee with hidden operational frictions, weighed against your long-term profit. To make the optimal choice, move away from the illusion of cheap and track the metrics driving real value. Surviving the competitive funding landscape requires ignoring the emotional marketing hype of a $50 challenge and calculating the strict mathematical ROI of a firm's structure. Let's break down exactly how these ultra-cheap firms extract revenue from the back end. Compare a budget $50 challenge to a premium $150 entry. Fail the budget one, you face massive reset fees, plus monthly platform and data subscriptions. Meanwhile, the premium firm absorbs those costs and offers a free retry. The cost stays locked at exactly $150. What looks like a low-risk entry is actually a mathematical liability. You end up spending more in administrative overhead over 3 months than if you had just bought the all-inclusive premium challenge from day one. But fees are just the beginning. The single most important metric for your long-term earning potential is the profit split. Imagine generating a 5% gain on a $100,000 account, creating a $5,000 profit pool. A budget firm's 60% split leaves you with $3,000. A premium firm's 80% split yields $4,000. That's a massive $1,000 opportunity cost lost to save $100 upfront. And that gap widens when you factor in a scaling plan. High-value firms automatically double your account size when you hit consistency targets, compounding those returns exponentially. When you sacrifice your back-end profit split and scaling potential just to get a cheaper challenge, you permanently kneecap your return on investment. It makes the cheapest firms the most expensive way to trade. Beyond the direct financial drain, budget firms rely on psychological friction to ensure you never reach the payout stage. The most common trap is the strict 30-day evaluation limit. When you have a hard deadline ticking down, the pressure forces you to abandon your strategy. You stop waiting for high-probability setups and start taking suboptimal, high-risk trades just to cross the finish line. Challenge structure matters here. A two-step challenge breaks the evaluation into manageable pieces, while a one-step challenge might cost more upfront, but it removes the time friction entirely, highly optimizing the time to profit for an experienced trader. But you have to watch out for structural red flags, like the ones on this scorecard. Look at this specific rule set: a massive 15% profit target paired with a maximum drawdown of just 5%. Statistically, these ratios are completely unbalanced. They mathematically require you to over-leverage your account just to have a chance at passing. If a firm's rules require reckless trading to succeed, you are handing over that $50 entry fee with zero mathematical chance of a return. So how do you navigate this? Your optimal purchasing decision depends entirely on which of two profiles you fit: the budget-constrained beginner or the confident optimizer. This decision tree maps the path for a beginner. Your strategy must prioritize survival and capital preservation over sheer speed. You need a firm that removes time limits and offers free retries so you can manage your nerves. For this profile, the best move is a two-step challenge. It's often cheaper initially, breaks the evaluation into manageable targets, and grants free retries if you end the period in profit. Now, if you are an experienced optimizer with an established win rate, you should ignore the initial checkout price entirely. Your only focus is maximizing the return on your edge, which means prioritizing 90% profit splits and aggressive scaling plans. For the optimizer, the one-step challenge is the clear choice. It cuts your evaluation time in half and gets you to your funded payouts much faster. True affordability comes from the removal of structural friction. The most cost-effective path is the one that gets out of your way the moment you become profitable. But passing the challenge is only half the battle. Once funded, your daily execution environment becomes the deciding factor in whether you keep those profits. That is why professional traders require an institutional-grade ecosystem to maintain their edge, which brings us to FXNX. The NX1 platform is built specifically to protect your capital. It features true 0.0 pip spreads and eliminates the hidden execution delays that quietly drain your accounts elsewhere. On large funded accounts, broker slippage acts as a direct tax on your performance. Minimizing that friction is a mandatory step for protecting your margins. To run the math on your next funding partner, click the link in the description to download the Prop Firm Cost Comparison Checklist. And when you're ready to secure a professional execution environment for your funded capital, visit FXNX.com.